Income Tax 2020. Health Savings Accounts, HSAs. Come in, relax with Income Tax 2020. Health Savings Accounts, HSAs. Within the income tax equation, we're going to be on the second line, remembering that we can break the income tax equation into two halves. The first half then being a modified income statement, the second half then being the calculation of the tax and application of the payments, the credits, to get down to the tax refund or the amount that will be due. We're going to be focusing in on the first half here, basically the modified income statement. On the second line, we can call that second line an above the line deduction, for example, or above the line deductions, as compared to the below the line deductions, or contrasted to the below the line deductions, which would be the standard deduction or the itemized deduction. These deductions up top could also be called deductions for AGI, Schedule 1 deductions, adjustments to income. So these are all different names that you might have for this group of the deductions we have up top. On the 1040, those will then be grouped together on the first page of the 1040 down here on line 10, and then they're going to be supported by the Schedule 1 Part 2. Now, I know this 1040 is a little bit small here, but I just want to show the whole 1040 so we can see it in context. We're concentrating here to get the calculation that will get us down to the adjusted gross income. In the following presentation, we'll actually put this into tax software and we'll zoom in to the fields on it, so we'll get a better look at the 1040 as we bounce around in the tax software example. And then on Schedule 1, Part 2, this is Part 2 of Schedule 1, we have the adjustment to income. We're looking here on line 12. That's where the health saving account deduction will be. We will also need to be attaching Form 8889. So that's going to be this form here. So here's the health savings account, HSAs. Form 8889, we're concentrating here on Part 1, which would be the contributions to it. So when we have the health savings account, we have Form 8889, and then it would flow into the adjustments to income if it's a contribution, and then that would flow into the 1040 on line 10. So that's going to be the basic scenario with it. Let's give a quick recap of what a health savings account is and when we might use a health savings account. Then we'll go into it in more detail. So the health savings account is typically tied to a particular type of insurance policy. That typically is a high deductible insurance policy. So if you have a high deductible insurance policy, you're basically trading off the fact that the premiums should be lower, but then when you have the medical expenses, then the insurance isn't going to kick in to be paying the medical expenses until you clear the higher deductible. So that could lead to people that have a high deductible insurance policy to be paying more out of pocket for their insurance expenses. And that's when basically the HSA would come into play. And the thought process here might be that they want to encourage people to do the checkups and the preventative care, which might have more out of pocket costs if you have a high deductible policy. So then you might be able to link a health savings account to it, meaning then you're going to put money into a health savings account, and then you get this basically adjustment to income. And then if you spend the money that in accordance with the health savings account rules, basically on medical expenses, then you'll get the tax benefit for it. So it's kind of similar to an IRA in that way. So you're going to put money into basically an account. Like if it was an IRA, you put money into an account that's specifically for retirement. And then if you spend it on retirement, you get a tax benefit for it, meaning you defer the tax. Similar process here. If you put the money into an HSA because it's linked to a high deductible insurance plan, then you get this adjustment to income, decrease in the amount of tax at that point in time, and then you got to make sure that you spend the money in accordance with what you put it in there, because you locked it in there for certain reasons, for medical expenses in essence. So that's the general policy. Now, then insurance, you could have a situation where people work at an employer, and basically the employer kind of links the health insurance. You're kind of going through your employer for the health insurance then, and they might then have a high deductible plan. In that case, they would have to report it on the W-2. So then you'd have to just make sure that you're reporting properly in the W-2. It would be in box 12 on the W-2. We'll see that shortly, and we'll see that in the following presentation as we do the data input. Or you might have a situation where they're self-employed or something like that, have a high deductible, and then you might have tax planning in that situation to say, is an HSA something that would be worthwhile to be setting up if you're talking to someone in that situation who has a high deductible plan and possibly is self-employed. Okay, so let's go into it in a little bit more detail. Now, this is the W-2 form, of course. So here's a W-2 form. And if the employer provided the health savings plan, the healthcare insurance, or they're getting healthcare insurance through their employer in some way, shape, or form, then, if it's a HSA that's going to be included, that's going to be on box 12 here. So it'll be box 12. I believe the symbol will be a W that would be included here. So you'll see it on the W-2 when you do the data input then, and we'll see this in the following presentation. Most software will then have box 12 and it'll have the forms for it. Now, if you have a question about anything down here in box 12 or any of the letters related to it, then of course you can go to the instructions related to the W-2, which will typically come with the W-2. And if they're not there, you can then go to the IRS website, just look up the W-2 and look up the instructions like we have here. And W here says the employer contributions, including amounts the employer elected to contribute using a Section 125 cafeteria plan to your health savings account. Report on Form 8889, Health Savings Account HSAs. So you can look at these instructions, and these symbols then will typically be what will be next to the box 12 line item right here. Okay, so then we could have then distributions from an HSA, and this is, I know it's a 2019 form, but note, this is something that you might get a 1099 SA. So now this one would be the money coming out of the health savings account, and notice that now it's a 1099 form. It came out, and we would think that it would come out for the use of medical expenses. So your thought then here is, well, now it's a 1099 if the money came out of the account. And the question is whether or not I need to record it in income for the fact that you have the 1099, and you got to look up and see whether or not you spent the money in accordance with the rules of the health savings account and so on. But we're going to be focusing in on the contributions at this point in time, the point in time that we're going to be getting the deduction. So that could be on the W-2, or they could have a health savings account that's going to be for a self-employed individual. Okay, so health savings account HSAs. Generally, an HSA is a health savings account set up exclusively for paying the qualified medical expenses of the account beneficiary or the account beneficiary's spouse or dependents. Distributions from an HSA used exclusively to pay qualified medical expenses of the account beneficiary, spouse, or dependents are excludable from gross income. So then that's going to be the benefit, obviously. When you put money into the HSA, you could get a tax benefit at that point. When you pay it out then, if you pay it in accordance with the HSA rules, then you don't have to include it in income, even though you're going to be getting the 1099 SA. So you're going to have to report it possibly here, but it might be something then that doesn't have to be included in income at that point in time, which is nice. So you can receive distributions from an HSA even if you are not currently eligible to have contributions made to the HSA. So in other words, you might put money into the HSA and be qualified to do so, and later on you're not qualified to do so, possibly because you no longer have a high deductible plan. Maybe you have another type of insurance plan that's not a high deductible plan, but you can still spend the money as long as you spend it in accordance with the rules of the HSA, even though you can't put any more money in because you no longer have the high deductible plan. So they don't want to, of course, lock you in to having a high deductible plan because you have an HSA if you want to move on to something that's not a high deductible, which is probably what the government would try to favor people to do if they could. So, however, any part of the distribution not used to pay qualified medical expenses is includable in gross income and is subject to an additional 20% tax unless an exception applies. So once you have the money in the HSA, you're restricted to it, just like with an IRA in essence. And if you take the money out and you don't use it in accordance with the rules of the plan, then you could be penalized for it. Generally, qualified medical expenses for HSA purposes are unreimbursed medical expenses that could otherwise be deducted on Schedule A, Form 1040 or 1040-SR. So qualified medical expenses are those things, and they're matching it to Schedule A, meaning you could get a deduction oftentimes on the itemized deductions, which are on Schedule A for medical expenses. Many people don't qualify for that because there's actually a threshold to be able to qualify even as an itemized deduction, and then of course you have to be able to itemize to be able to take advantage of those there. So that's why the HSA is beneficial, of course, because many times people wouldn't get the deduction for medical expenses because, one, they don't itemize, and two, even if they did, they're going to have a restriction before they get any benefits for the medical expenses. And we'll talk more about that later when we get to the Schedule A deductions. But if you want to consider or look into more detail of what would qualify for something that would be spent from an HSA, you can look and get an idea from the medical expenses deductions on the Schedule A. So see the instructions for Schedule A and Publication 502, medical and dental expenses. Expenses incurred before you established your HSA are not qualified medical expenses if, under the last month rule, you are considered to be an eligible individual for the entire year. For determining the contribution amount, only those expenses incurred after you actually established your HSA are qualified medical expenses. So even if you qualify for the year, if the medical expenses were there before you made the HSA, then they don't count. So self-only coverage, these are the max contributions to an HSA. You can put in the $3,550 if you're self-coverage. Family coverage, then the max contribution you can have would be the $7,100. This would be, of course, the max benefit that you could basically get. And if it was like your own HSA, not through the work, you'd see it be deducted on the Schedule 1. If it's going through work, then of course they might take care of that in the W-2, and we'd have to basically report that. And we'll take a look at those two separate scenarios and how they might look in the tax software in the following presentation. So health savings account, HSAs, Form 8889. Report health savings account, HSA contributions, including those made on your behalf and employer contributions. Figure your HSA deduction, report distributions from HSA, and figure amounts you must include in income and additional tax you may owe if you fail to be an eligible individual. So in other words, Form 8889 is going to be covering both the contributions, which is what we're focusing in on here, as well as the distributions and whether or not those distributions are going to be something that are going to require adding to income and or having a penalty applied to them or not. Form 8889, you must file if any of the following apply. So these are when you must file the Form 8889, which is linked to the HSAs. You or someone on your behalf, including your employer, made contributions to an HSA. So you made the contribution to the HSA, whether it be you or your employer. If it's your employer, they'll report that on the W-2. But the W-2 information, as we do the data input, will still have to be populating the Form 8889. We'll take a look at that in a following presentation. You receive HSA distributions. So if you take money out then of the HSA, hopefully for medical expenses that would then qualify for the reason the HSA was opened, you must include certain amounts in income because you failed to be an eligible individual during the testing period. So then you'd have to, if that were the case, you'd have to report that. You acquired an interest in an HSA because of the death of an account beneficiary. So if there's a death of a beneficiary and then the HSA possibly goes to you, then you'd have to be qualified, you'd have to file the form. Eligible to have contributions made to an HSA. So who can put money into an HSA? And this is going to be important, of course, if you're talking to someone who has questions about an HSA. You want to be your idea would be, okay, do you work for somebody else? Do you have insurance with the somebody else? Is it a high deductible insurance policy? And that's going to be the key. If you don't work for somebody else, then do you have a high deductible insurance policy? If so, then you might be able to set one up. If you have one with the work, then you might be able to ask them whether or not they can look into setting up an HSA through the work as well. So eligible to have contributions made. You must be covered under a high deductible health insurance plan. So it's got to be an HDHP, high deductible health plan, and have no other health coverage except permitted coverage. So you're locked into the high deductible plan, which is usually, like we say, like a cheaper plan, because it's got the high deductible, and therefore the amount of the premiums will generally be cheaper. And in order to cover the out-of-pocket costs for the medical expenses, then that's when the HSA may come into play. So if you are an eligible individual, anyone can contribute to an HSA. However, you cannot be enrolled in Medicare or be another person's dependent. So if you're in Medicare or if you're someone else's dependent, then no HSA. An individual does not fail to be treated as an eligible individual for any period merely because the individual received hospital care or medical services under any law administered by the Secretary of Veterans Affairs for a service-connected disability. You must be or be considered an eligible individual on the first day of the month to take an HSA deduction for that month. So there's, you got the rules in terms of when the cutoff is going to be applied here. Last month rule: if you are an eligible individual on the first day of the last month of your tax year, December 1st for most taxpayers, you are considered to be an eligible individual for the entire year. And then for 2020, the IRS defines a high deductible health plan as any plan with a deductible of at least $1,400 for an individual or $2,800 for a family. So if you're thinking about your health plans and your options for health plans and what is a high deductible plan and so on and so forth, this would be the kind of IRS definitions of what a high deductible plan is, right? An HDHP. So an HDHP's total yearly out-of-pocket expenses, including deductibles, co-payments, and co-insurance, can't be more than $6,900 for an individual or $13,800 for a family. This limit doesn't apply to out-of-pocket network services.